A budget is a plan that tells a business how much money it expects to earn and spend over a certain period. Master budget, think of it as the master recipe that combines all the smaller budget sales, production, cash, etc. into one complete picture. It covers a full fiscal year and is the primary tool that senior management uses to set targets and allocate resources. Operating budget, this is the day-to-day part of the master budget. It includes the sales budget, production budget, direct materials budget, direct labor budget, and overhead budget. It focuses on the operating activities that generate revenue and incur costs. Financial budget, this portion shows how operating decisions affect the company's financial position. It includes the cash budget, budgeted balance sheet, and budgeted income statement. It is like a financial GPS that tells you whether you will have enough cash to keep the lights on. Zero-based budget, unlike traditional budgets that start with the previous year's numbers and add a percentage, ZBB starts from zero each period. Every expense must be justified as if it were new. Imagine planning a family vacation where you list every possible cost, flight, hotel, meals from scratch rather than using last year's trip as a baseline. ZBB forces managers to think critically about every activity, often revealing waste and encouraging better cost-benefit analysis. Key characteristics. Time horizon master budgets are annual operating budgets, often break down into monthly or quarterly slices. Level of detail, operating budgets are detailed, for example, per unit material usage, while financial budgets are summarized. Flexibility, traditional budgets are static, ZBB is highly flexible but time-intensive. Purpose, master budgets coordinate the whole organization, operating budgets guide day-to-day operations. Financial budgets assure solvency, and ZBB drives cost-conscious decision-making. Explanation, preparing a master budget is like building a house. You first draw the overall blueprint, then add each room, wiring, and plumbing, making sure everything fits together. Step 1. Sales budget. Estimate units to sell for each month. Example, 10,000 units in quarter 1, 12,000 in quarter 2, etc. Multiply by the selling price to get sales revenue. Step 2. Production budget. Use the sales forecast, desired ending inventory, and beginning inventory to compute how many units must be produced. Required production equals sales forecast plus desired ending inventory minus beginning inventory. Step 3. Direct materials budget. Determine material needed per unit, then apply the same inventory logic. Material needed equals units to produce times material per unit. Materials to purchase equals material needed plus desired ending material inventory minus beginning material inventory. Step 4. Direct labor budget. Multiply planned production by labor hours per unit and labor rate. Labor cost equals units to produce times hours per unit times rate per hour. Step 5. Manufacturing overhead budget. Separate variable overhead cost per machine hour from fixed overhead such as rent and salaries. Step 6. Selling and administrative budget. Estimate variable selling costs, for example commissions, and fixed selling and administrative expenses. Step 7. Cash budget. Start with beginning cash, add cash receipts from sales collections, subtract cash disbursements for materials, labor, overhead, selling and administrative expenses, capital expenditures, and loan payments. The result is ending cash. If it falls below the minimum policy, you plan a borrowing or financing action. Step 8. Budgeted income statement. Pull together the revenue from the sales budget, subtract cost of goods sold, which includes production, material, labor, and overhead, and subtract selling and administrative expenses to derive gross profit, operating profit, and net income. Step 9. Budgeted balance sheet. Use ending cash, ending inventories of finished goods, raw materials, and work in process, and projected assets and liabilities to present a snapshot of the financial position at period end. A static budget is a one-time plan that does not change even if actual activity levels differ. It is like a fixed price menu at a restaurant. The price is set regardless of how many customers show up. A flexible budget, by contrast, adjusts to the actual level of activity, for example units produced or sold. Think of a rideshare app that changes driver pay based on the number of trips taken. Construction static use the expected activity level, often the budgeted sales volume, to compute all cost lines once. Construction flexible identify cost behavior variable costs vary directly with activity fixed costs stay constant in total and mixed costs, are split into variable and fixed components. Then plug the actual activity level into the variable formulas. Flexible budget cost equals fixed portion plus variable rate times actual activity. Purpose static budgets are useful for setting targets and for performance evaluation when the activity level is relatively stable. Purpose flexible budgets provide a fair basis for variance analysis because they compare actual results to what costs should have been at the actual activity level. Variance implications static budget variance equals actual minus static budget. It mixes both price efficiency variances and volume quantity variance. Variance implications flexible budget variance equals actual minus flexible budget. This isolates pure price efficiency issues because the volume effect is already accounted for. Example: a company budgets $5 per unit variable cost for 10,000 units static budget equals $50,000. Actual production is 12,000 units, and actual variable cost is $58,000. Static budget variance equals 58,000 minus 50,000 equals 8,000 unfavorable, contains 2,000 volume variance. Flexible budget amount equals 5 times 12,000 equals $60,000. Flexible budget variance equals 58,000 minus 60,000 equals 2,000 favorable pure price variance. Thus, flexible budgets give managers a clearer picture of where they are truly over or underspending. The three core operating budgets, sales, production, and direct materials, are linked like a three-gear transmission. The output of one gear drives the next. 1. Sales budget. Forecast units to be sold for each period, often based on market research, historical trends, and sales force input. Multiply by selling price to get sales revenue. Example: forecast 8,000 units in January at $25 each yields sales equals 8,000 times $25 equals $200,000. 2. Production budget. Formula. Required production equals expected sales plus desired ending finished goods inventory minus beginning finished goods inventory. Desired ending inventory is usually a percent of next month's sales. For example, 20%. Example: desired ending inventory for January equals 20% of February's forecast, 9,600 units, yields 1,920 units. Beginning inventory equals 1,500 units. Production equals 8,000 plus 1,920 minus 1,500 equals 8,420 units. 3. Direct materials budget. Determine material needed per unit, for example 2 kilograms of steel per widget. Compute total material needed for production. Material needed equals units to produce times material per unit. Apply inventory logic. Materials to purchase equals material needed plus desired ending material inventory minus beginning material inventory. Example: 8,420 units times 2 kilograms equals 16,840 kilograms needed. Desired ending inventory equals 10% of next month's material requirement. Assume 17,280 kilograms, yields 1,728 kilograms. Beginning inventory equals 1,200 kilograms. Purchase equals 16,840 plus 1,728 minus 1,200 equals 17,368 kilograms. Key formula summary. Sales revenue equals forecast units times unit selling price. Production equals sales plus desired ending finished goods minus beginning finished goods. Material needed equals production times material per unit. Materials to purchase equals material needed plus desired ending material inventory minus beginning material inventory. These calculations give managers a concrete data-driven plan for how much to make and what resources to buy, avoiding stock outs or excess inventory. Explanation: direct materials variances compare what was actually spent on raw material with what should have been spent according to the standard budget cost. Two separate measures are used: price or spending variance and quantity or usage variance. Formulas: price or spending variance. MPV equals actual price minus standard price times actual quantity purchased. Quantity or usage variance. MQV equals actual quantity used minus standard quantity allowed times standard price. Standard quantity allowed equals actual output times standard material per unit. Numerical examples. Assume standard price equals $4 per kilogram, standard material equals 2 kilograms per unit. Actual production equals 8,420 units from the production budget. Actual purchase equals 17,368 kilograms at $4.20 per kilogram. Actual material used equals 16,800 kilograms, a little less than purchased, because of ending inventory. Price variance equals $4.20 minus $4 times 17,368 equals $0.2 times 17,368 equals $3,473.60 unfavorable. Spending more than expected. Standard quantity allowed equals 8,420 units times 2 kilograms equals 16,840 kilograms. Quantity variance equals 16,800 minus 16,840 times $4 equals negative 40 times $4 equals negative $160 favorable. Used less material than allowed. Interpretation. A price variance points to purchasing decisions, supplier negotiations, or market price swings. A quantity variance signals production process efficiency, waste, or theft. Managers investigate unfavorable price variances, first maybe renegotiate contracts, and then look at usage issues, perhaps improve handling or train workers. The two variances together explain why the total material cost deviated from the budgeted amount. Direct labor variances evaluate how the actual labor cost stacks up against the standard cost that was planned. Like material variances, we separate a rate price component and an efficiency quantity component. Labor rate variance, LRV, equals actual rate per hour minus standard rate per hour times actual hours worked. Labor efficiency variance, LEV, equals actual hours worked minus standard hours allowed times standard rate per hour. Standard hours allowed equals actual output times standard hours per unit. Assume standard labor rate $18 per hour, standard labor per unit 0.5 hour. Actual production 8,420 units from the production budget. Actual labor hours recorded 4,500 hours. Actual hourly wage paid $19.50. Labor rate variance equals $19.50 minus $18 times 4,500 equals $1.50 times 4,500 equals $6,750 unfavorable. Higher wage or overtime. Standard hours allowed equals 8,420 times 0.5 equals 4,210 hours. Labor efficiency variance equals 4,500 minus 4,210 times $18 equals 290 times $18 equals $5,220 unfavorable. More time taken than planned. The rate variance may be due to higher wage rates, overtime premiums, or use of higher skill and higher paid workers. The efficiency variance points to operational problems, possible machine breakdowns, learning curve issues, or poor work methods. Managers can address the rate issue by reviewing labor agreements or scheduling, and the efficiency issue by improving training, maintenance, or workflow layout. Variable overhead consists of costs that vary directly with the level of activity, for example, electricity for machine hours and indirect materials. Similar to material and labor, we separate a spending price variance from an efficiency variance. Formulas. Variable overhead spending variance VOSV equals actual rate per activity unit minus standard rate per activity unit multiplied by actual activity units. Variable overhead efficiency variance VOEV equals actual activity units minus standard activity units allowed multiplied by standard rate per activity unit. Standard activity units allowed equals actual output multiplied by standard activity per unit, for example, machine hours per unit. Numerical examples. Assume standard variable overhead rate equals $3 per machine hour. Standard machine hours per unit equals 0.2 hour. Actual production equals 8,420 units, leads to standard machine hours allowed equals 8,420 multiplied by 0.2 equals 1,684 hours. Actual machine hours used equals 1,800 hours. Total variable overhead incurred equals $5,580. Actual variable overhead rate per hour equals $5,580 divided by 1,800 equals $3.1 per hour. Spending variance equals 3.10 minus 3.00 multiplied by 1,800 equals $0.10 times 1,800 equals $180 unfavorable, higher utility rates or waste. Efficiency variance equals 1,800 minus 1,684 multiplied by $3 equals 116 times $3 equals $348 unfavorable. More machine time used than expected. Interpretation. The spending side urges a review of utility contracts, equipment condition, or waste control. The efficiency side flags possible bottlenecks, longer than planned setups, or underutilization of capacity. Both variances together show that the variable overhead cost overruns are due partly to higher rates and partly to using more machine time than planned. Fixed overhead is budgeted to remain constant in total over a given range of activity. Two variances are examined, the spending budget variance and the volume or production volume variance. Formulas: fixed overhead spending budget variance, abbreviated FOSV. FOSV equals actual fixed overhead minus budgeted fixed overhead. Fixed overhead volume variance, abbreviated FOVV. FOVV equals standard production hours allowed minus actual production hours times fixed overhead rate per hour. Fixed overhead rate per hour equals budgeted fixed overhead divided by budgeted denominator activity level, usually standard machine hours or labor hours. Numerical example: budgeted fixed overhead for the year equals $120,000. Budgeted denominator level equals 10,000 machine hours. That is, the company expects to run 10,000 hours. Therefore, fixed overhead rate per hour equals $12 per hour. Actual fixed overhead incurred equals $125,000, maybe higher insurance premium. Actual machine hours used equals 9,000 hours, production fell short. Spending variance equals $125,000 minus $120,000 equals $5,000 unfavorable, costs rose. Volume variance equals 10,000 minus 9,000 times $12 equals 1,000 times $12 equals $12,000 unfavorable. Because the firm did not achieve the expected activity level, the fixed cost per unit appeared higher. Interpretation. The spending variance signals that fixed cost items such as rent, depreciation, insurance were higher than anticipated. Management may renegotiate contracts or defer non-essential expenses. The volume variance reflects the operational side. When production is below the denominator level, each unit bears a larger share of fixed cost, hurting profitability. Managers can improve the volume variance by better capacity planning, smoothing production, or adjusting the denominator level for future budgets. Executive summary: highlight total cost variance, favorable or unfavorable, and its impact on operating profit. Sales variance: compare actual sales revenue to the flexible budget revenue. Explain price mix effects or volume changes. Cost of goods sold variance break down into direct materials price and usage variances with dollar amounts and percent of material cost. Direct labor rate and efficiency variances. Variable overhead spending and efficiency variances. Fixed overhead spending and volume variances. Contribution margin analysis. Show how each variance affected contribution margin. Root cause commentary. For each unfavorable variance, provide a concise diagnosis, for example, material price variance caused by a 15% increase in steel tariffs. Action recommendations. Specific steps: renegotiate supplier contracts, implement overtime policy, improve machine maintenance schedule, adjust denominator level, etc. Appendix: detailed calculations for audit trail. Managerial implications. Performance evaluation variances tie back to responsibility centers, for example, purchasing manager for material price variance. Strategic decisions. Large volume variances may suggest re-examining capacity or market forecasts. Cost control, recurrent unfavorable spending variances, indicate systemic issues that need process redesign. Exam type interpretation. Question 1. A company shows a $40,000 favorable materials usage variance, but a $55,000 unfavorable materials price variance. What is the overall effect on material cost, and what managerial action would you suggest? Answer. Net material cost is $15,000 higher than budget. Unfavorable. Investigate supplier price changes. Consider alternate vendors or forward contracts while preserving the efficient usage practices. Question 2. Explain why a flexible budget labor efficiency variance of $8,000 unfavorable could be offset by a favorable labor rate variance of $5,000. Answer. Workers took more hours than allowed. Inefficiency raising cost, but the average hourly wage paid was lower than the standard, perhaps due to using less skilled, cheaper labor. Net labor variance is $3,000 unfavorable. Management must weigh lower wages against possible quality or overtime implications. Question 3. If the fixed overhead volume variance is $20,000 unfavorable, what does this tell you about the relationship between actual output and the denominator level? Answer. Actual activity was lower than the level used to set the fixed overhead rate, causing each unit to absorb more fixed cost. It suggests underutilization of capacity and may require